Who wants to talk about the exciting topic of taxes? How much more exciting can you get? You're in Vegas, and I'm up here talking about taxes. It's hard to believe. Does everybody know what Monday is, by the way? Yeah? It's the deadline for filing tax returns. That's right. So hopefully everybody's filed, okay? And if not, hopefully your returns are on my desk waiting for my review. But how many of you actually heard me speak before? Oh, okay. So knowing that, I had to come up with some new jokes, you see, because I don't want to tell the old jokes because you heard them already. First off, I want to thank Tom and Michelle and the family for having me here. I'm kind of losing my voice a little bit. Been a little busy lately. But thanks a lot for having me again. I don't know why, but for some reason they like hearing me. Interestingly enough, a lot of what they do kind of ties into taxes because, think about it, the less taxes you pay, the more money you have to invest. And the last I heard, I've done a lot of seminars and I've yet to find any one person who said I like paying more taxes. So if there's anybody who likes paying more taxes, raise your hand because I think you're at the wrong seminar. That's all I can tell you. I think you need to be out on the casino floor, okay? So yes, the tax deadline is Monday and hopefully everybody's filed. I'm going to talk about a lot of things today. I'll tell you a little bit about my background for those who haven't met me before. And then we're going to talk about, if you're in business, how you should be doing business. And the most important topic I think Tom and Michelle wanted me to talk about is the new tax law for 2018. Or as I like to call it, the Jack Cohen Full Employment Act, okay? Because as far as I'm concerned, the more complicated taxes are, the more secure my job is because, you got to do something in life, okay? And so, first off, let's tell you a little bit about my background for those who have never heard me speak or met me. As you just heard, I worked for the IRS for 33 years, actually. It wasn't 30, but it's 33. Okay, the last 3 were a killer, by the way. I basically ended my career in large corporate audits. So if there was any Fortune 500 company that was located in the Philadelphia area, for instance, Bell Atlantic, Cigna Insurance, I probably managed the federal tax audit of those companies. And so my entire working career had been with the IRS. And in 2006, in large corporate audit, I was the #1 employee in the country. And I ended up retiring to Vegas and then unretiring. And it turned out, go figure, as good as I was working for the IRS, and I was really good, I'm just as good working on the other side. And we represent tons of different people, tons of different clients. My client base is all around the country. My firm name, I'm a partner in a firm called Campbell Jones Cohen. And basically my clients are literally around the United States and in many foreign countries. And so it doesn't matter where you're located at. Pretty much we probably have clients there. And I know I already have clients sitting out here. I'm just hoping I didn't screw up your tax returns this year. That's all I got to say. My theory is this, though, too. If you're a client that's located far away and you get really mad at me and you want to come out here and kick my ass, so you're going to go drive to the airport. You got to get an airline ticket. Then you got to get a rental car. Then you got to find my office. And by the time you find me, you'll probably be calmed down. I'm just saying. So anyway, okay. So first thing, let's talk about, I got to tell you my accounting joke. So a CPA goes into a pet store and he wants to buy a parrot. And there's 3 parrots sitting there. And he says to the pet store owner, well, how much is that parrot on the left? And the pet store owner says it's $500. And the CPA says, well, what can he do? And he says, well, he can do complicated financial statements. Oh, wow, okay. Then he points to the parrot in the middle. And he says, well, how much is that parrot? And he says, well, that parrot's $1,000. And he says, well, what can that parrot do? And the pet store owner says, well, he can do everything that the first parrot can do, but he could also do financial forecasting as well. Wow. Then he points to the parrot on the right, and he says, well, how much is that parrot? And he says, well, he's $4,000. And he says, well, what's that guy do? What's that parrot do? And the pet store owner says, I don't know what he can do, but the other 2 refer to him as senior partner. So I don't know. Okay. Now, for those who have never met me before, I'll hit you with the old joke about the woman who goes to the doctor and he tells her some really bad news. And he tells her she only has 6 months to live. And she says, doctor, isn't there anything that you can do to help me live longer? He says, well, if I was you, I'd marry a CPA. And she says, will that help me live longer? He says, no, it'll just seem like it. We are a wild and crazy bunch, our CPAs. That's all I can tell you. One other quick story I want to repeat. I had done I guess, was it like a webinar or something we did, Tom? Or about 3 weeks ago or something. And Tom asked me, see if you can tell everybody a really, really funny story that happened either while you were at the IRS or since you've been in private practice. And so this is a true story. I couldn't make this stuff up. So we had a client that she was pretty much really nervous all the time. And somehow, she must have gotten a notice from the IRS. And it was probably a nothing notice, but any notice from the IRS could be upsetting. And she decides that she wants to call the IRS on the phone herself. Somehow, they must have thought that she was going to commit suicide. So they dialed 911. And the police showed up at her door and broke down the door because they thought she was going to kill herself. And as Michelle said to repeat, the moral of this story is never call the IRS on your own and never contemplate suicide if you're having a problem with the IRS. It just ain't worth it. So, okay. So I don't know for sure, but I know some of you obviously are in business for yourself. And so if you're in business for yourself, I know you had, I guess, Lee Phillips up here a little while ago. You know, if you're going to be in business for yourself, you really need to be in business as either a corporation or an LLC. And you need to do it for a couple of reasons. Number one, you do it for liability reasons. And number two, that's pretty much the easiest and fastest way to save some taxes, because the stone cold truth is that even if you're a little corporation, the same rules, the same tax laws that apply to little corporations apply to big corporations. It's just that obviously most people don't know what the rules are, and so consequently you kind of find yourself at a disadvantage. So if you're going to be in business for yourself, you really should do so as a corporation for liability, and it is the easiest way to save taxes. And so one of the things we do is that basically we are considered a commercial registered agent. And basically what that means, in fancy words, is that we can set up companies for you no matter what state you're located in. We obviously like Nevada, which is a very, very tax-friendly state. And by the way, when I start talking about the 2018 tax law, it's going to be even more popular because the new tax law was not that popular. It's not going to work out that well for people who live in states that have high income taxes and have high property taxes. What do I tell everybody all the time? Most of the movie stars in California, they all have homes here. I mean, there's no law that says you can't have more than one home. Everybody remember when John McCain ran for president the first time, and they asked him, well, how many houses do you have? And he said like 7. But then he couldn't remember where they were. Perhaps that was a reason why he didn't get elected. But so you can have as many as you want, but you can only have one tax home. And consequently, a lot of people in California, especially the movie stars, they've decided to make their tax home here in Nevada because it really is tax friendly. Because you know how much taxes are here? How about 0? There is no personal income tax at all. And for most companies, there's no corporate tax either. So it's a really tax-friendly state. Plus, we got really nice weather, too. Let's talk a little bit about, and I'm going to jump around a little bit, but let's talk about the 2018 tax law. And what happens is, basically, when Congress passes a new tax law, the IRS then has to issue what they call their regulations. And that's just another fancy word for saying it's their interpretation of the tax law. And sometimes it takes a really long time for the IRS to kind of issue their regulations as to what their interpretation is. Keeping in mind that their interpretation doesn't mean that they're correct. It's just their spin on the tax law. Consequently, if there was something that was somewhat ambiguous in the tax law, hey, if I'm your CPA, we're going to take an aggressive position. We're going to do what we think is best for the client, and that's the way it goes. Okay. So this new tax law was probably, well, it's the first big change in tax law since what year? This is where I ask everybody the question. Does anybody remember what year the last big tax law change was? Probably got to be someone a little older. How about 1986? The Tax Reform Act of 86. A lot of new changes then. This is the first big tax law change since then. And as I said, I think at the last McPhee seminar, I look at this like the Clint Eastwood movie, the good, the bad, and the ugly. Because the truth is, there's some really good stuff in this tax law, and there's some stuff that's kind of in the middle, and there's some stuff that's probably not so good for some people. It depends. It depends on where you are. Let's talk about the good stuff. Everybody know that one of the good things that happened is that the tax rates and the highest rate has changed, where the highest individual rate used to be like 39%. Anybody here win at 39%? Because if you are, I'm available for adoption, okay? I'm just saying, you know. Well, now it's down to 37%. So the highest rate dropped, and also all the brackets changed too. So the truth is, if you did your own tax return, even on TurboTax, I don't know this for sure, but most tax softwares already have built in. They'll take your tax return for the current year, and they'll flip it into the 2018 tax law. It's not going to tell you everything, but it may give you some idea as to how you would fare in 18. That's based on the change in brackets, the change in rates, and some deductions, which you may lose. Okay, so that's a really good thing. Most people are interested in capital gains. They pretty much stay the same. Capital gains are a good thing. I'm just saying, you know, we like capital gains. Another thing that really is going to help business owners out, there's a new code section, and I think it's 199 if you like throwing code sections out. And basically what it says, if you're in business for yourself, instead of having to report 100% of your income, you only have to report 80% of your income. Now, there's a couple caveats to that, and there's some exceptions. But the general rule is, if your business made $100,000, let's say, and say in 2017 you had to report $100,000 as income, well, in 18 you only got to report $80,000 as income. That seems like a pretty fair deal. Would you not agree? And that actually is going to apply whether you're in business either as a corporation, well, as an LLC. So if you file, if you're in business and you file a subchapter S return for yourself, it's going to apply. And it even applies if you're a sole proprietor. And we're going to talk a little bit about structuring and sole proprietorships. We don't like them. You pay too much tax. But the bottom line is there are some exceptions to that 20% rule. But for the most part, I think most people are going to be able to take advantage of this. It's a really good thing, okay? Let's talk about some other things that changed. They tried to kind of eliminate a lot of itemized deductions. And conversely, they increased people's standard deduction. So like if anybody's a W-2 employee and you've claimed like employee business expenses in the past, they're gone. No more employee business expenses. Most casualty losses are gone unless you live, I think, in a state of disaster area. Here's one that would have killed me. They did away with this deduction for alimony. You know how many times I've been married? That was a great deduction, okay? Well, guess what? And also, you know, the interesting thing is when people got divorced, that deduction actually became part of the negotiation. Because if I'm getting divorced and I can settle my divorce with the wife and pay her alimony and I get a deduction for it, that's a good deal for me, especially if I'm in a high bracket. And I think the government figured out on that one that basically, generally the person paying the alimony was in a higher bracket and the person receiving the alimony was in a lower bracket. So pretty much the government was getting beat on that one. But no more alimony deduction. I'm telling you, that's not good. We like it. Well, we don't like having to pay it, but we just like to be able to take the deduction. Okay, so that was another big thing that went out. But here's the I think the one area that I think is going to affect people the most, and it's kind of tied in with the idea that they really don't like people itemizing their deduction. Well, let me step back. One other quick note: mortgage interest. In the past, most people probably this didn't apply to, but if you had mortgage interest on your personal residence, and the mortgage was more than $1 million, did you know that you couldn't take all the interest deduction? $1 million was the cap. So if you had $3 million in mortgage interest on your home, you really can only get the mortgage interest deduction on $1 million. Well, now they dropped that to $750. Sorry. And by the way, that's for new mortgages. I believe if you already have the mortgage, the grandfathered in. But the biggest item we refer to as salt. Everybody know, I'm not a doctor, but I think salt's not supposed to be good for you, is it? I think it's bad for you. I'm not sure. SALT stands for state and local income taxes. So in the past, say you were someone who lived in California. Anybody here from California, by the way? We have so many clients from California, it's unbelievable. You'll be my neighbor by this time next year, trust me, when you see what happens, okay? So I'll use California as an example, but it's not just California. I came from New Jersey, high income taxes, high property taxes. New York, same thing, Illinois. So in the past, what would happen is on your federal tax return, you would get a tax deduction for what you paid in state income taxes and in real estate taxes. Well, California has high personal income taxes, and they have really high real estate taxes. So some people who, and remember, you have to, in many cases, you have to make a lot of money in California to be able to live in California because it's so expensive to live there. So, you know, you could have someone who's paying $50,000 a year to California between state income taxes and real estate taxes. That's no big deal. Well, in the past, of course, you get to deduct that on your federal income tax return, right? So effectively, the federal government is subsidizing those taxes because let's make believe, I'll use an even number because I'm really not good at math. But let's just say there really was a 30% bracket. There's not, but I'm not good at math. So if you were in the 30% bracket and you paid California $50,000 a year, 30% times 50,000, you save $15,000 in federal income taxes. So effectively, the federal government was subsidizing you paying your state income taxes and your real estate taxes. Well, guess what? It turns out the people who lived in those states did not vote for Don, okay? And so one of the new tax laws is that deduction is now limited to $10,000. So if you had been paying them $50,000 in the past and taking a deduction for 50, guess what? 10,000. And to top it off, remember that was just part of your itemized deductions. So now that's capped at 10. They eliminated all miscellaneous. You probably have hardly anything left after that because usually, you know, taxes is probably the biggest deduction on your Schedule A. Now, they did increase the standard deduction, but I'm thinking in the best case scenario, if you live in one of those states, keeping in mind that the rates became lower, but now you lost that deduction, I'm thinking if you broke even on this deal, that would still not be a bad deal. But I don't know that you're going to benefit out of this because you're losing that deduction. As Donald Trump would say, that is a huge deduction, okay? And yes? That real estate, it's state and local income taxes and real estate taxes, yes. Yes, real estate taxes. And I know in Jersey, I mean, I lived in Cherry Hill, which is pretty high real estate taxes, and Haddonfield was next to us. I mean, you could pay $15,000, $20,000 a year just in real estate taxes. Well, now all that stuff is kind of smushed together. You get 10 grand. That's it. That's it. If you paid 50 or 60 or whatever it was, you get a $10,000 deduction. That's it. So there's no doubt in my mind that if you live in one of those states, pretty much you're going to come out on the short end of the stick. Okay? Now, for people like myself who live in, wait, I have to pronounce it correctly, Nevada. Wait, I always pronounce it wrong. I'm from Jersey. I say Nevada. It's Nevada. If you live in Nevada, okay, that's not an issue because our real estate taxes are pretty low here and there is no income tax at all. So for us, it's going to benefit us, but if you live in California, probably not. So when you go home, you're going to go hire the U-Haul truck and put the sale sign up and start moving. Any other questions? I'm trying to think if there's any other highlights of the Tax Reform Act of 18. Yeah, I can barely see it, but.
Does that also apply to business and operating taxes?
No, that's only personal stuff. So for example, if you have rental properties, it doesn't apply to interest and taxes on rental properties. If you're in business, it doesn't apply to business expenses. Or for example, Let's go back to whole life policies. If you borrow money on a whole life policy and you use the money for business, you see the interest you pay back to the whole life? That's a business deduction. That counts. That's still okay. Another thing that still counts is they didn't eliminate the investment interest expense. So again, if you borrow money and you use the borrowed money to invest, that's still an allowable deduction. Yes?
So back up, you said doesn't apply to business expenses. So you hold your real estate in an LLC doesn't apply?
If it's investment property, those rules don't apply. It's only to personal income
Homes.
taxes and personal homes. That's correct. Yes. Yes. That's right. Good question. Yes.
Thank you. You mentioned previously something about W-2 expenses. Could you go over that again?
Sure. Okay, everybody here? She said something about W-2 expenses. So if you're a wage earner, say you don't have your own business, and many times you work for another company and you get a W-2, there are times when basically you have to spend money for your job that you're not reimbursed for. And you can actually claim that, or you could have claimed it up until now, as an itemized deduction on Schedule A. Okay, there's some math that's involved in there, but you can get a deduction for that. That deduction's gone. You can't claim that anymore. And so, again, this is where you have to be a little creative. For example, if you have a business, you would want all those deductions to be on the business return, not on your personal return. And we're going to talk a little bit more about business returns. But there is some strategy involved in how your corporation is formed for taxes, where you're going to take deductions, because you want to be able to take deductions where you're going to be able to take the deduction, okay, and maybe not have it on your personal return. And by the way, that's been my story for a long time. When we have clients that have businesses, pretty much the only thing we want to see on your personal tax return are W-2s and K-1s. And if people that are in business know what a K-1 is, we don't want any business on your return. We don't even like rental properties on your return. Would you like to know why? Okay, I'm glad you asked. Do you know, this is true, I couldn't make this stuff up. Every year, the Treasury Inspector General gives a report card to the IRS on how it's doing. And if you can either find it yourself, or if you email me, I'll email you the last report, which is only, I think, came out like last month. And in that report, they basically tell everybody who they audit, how many returns, what categories. In other words, what percentage of returns actually get selected for audit. What if I told you that if you filed a business return, either as a corporation, the letter C, or as an 1120S, or even as a general partnership, the audit selection rate for that actually went down. It used to be 0.5%. Now it's 0.25%. So of all those returns that are filed, 0.25% of those returns will get selected for audit. So I would pretty much argue that the odds of you getting audited by filing one of those returns are pretty much slim and none. What if I told you your personal return has a higher percentage chance of getting audited than that? So consequently, you might want to call it audit insurance, but A, if you get a tax benefit from keeping stuff off your personal return and you've reduced the chances of getting audited, why wouldn't you want to do that? By the way, I represent a lot of people in IRS actions, either audits and collection. And I'm being a little modest here, but I'm really good at it, okay? I really am. But it's painful and it's expensive. I don't want to make money representing you on an audit, trust me. Will we do okay? Of course we will. What do I like to tell people? This is not a funny story, but none of my clients have ever gone to jail yet. Now the bar's pretty low there. So we don't want to have any test cases here, okay? So, but statistically, you're far less likely to get audited by filing a business return. I think we had a question now. The 2106, I don't know if they're doing away with the form, but it may as well go away. I think you used to be able to use the 2106 for other reasons, like if you had some automobile expenses, even on a corporate return. but the deduction itself can't end up on your 1040 anymore. It's Vegas. You're cold. I know. The only place I know where it's 120 outside and you need a jacket in the casinos. I don't get this. That's all I can tell you. Any other questions on the new tax law? Yes.
I might have misheard you, but did you say that there are going to be a reduction in the itemized deductions?
Yes, practically all of the miscellaneous are gone. Absolutely. So anything you would list as a miscellaneous, even when you would put down your tax preparation fee, there was a line for that. That's gone too. They basically are, and by them raising the standard deduction, they basically don't want you to itemize anymore, is what it pretty much comes down to.
What's the benefit in incorporating on the LLC side for people who are sole proprietor?
Oh, that's a great question. Thank you. I'll pay you later. So let me go back. So let's talk about that. And when you're in business as a sole proprietor, first of all, you don't have any liability protection. Now, you may think that's not a big deal, but we live in a very litigious society. I know I used to own a lot of real estate in my day. You have no idea how many times I got sued. It was all bull, but nevertheless, I got sued. So number one, if you're in business as a sole proprietor, and by the way, you can be an LLC and still file as a sole proprietor. Did you know that? The IRS wants you to think that they're doing you a favor. It's called a single member LLC. So you form the LLC, but the IRS says, you know what? If you want, you don't have to file a separate corporate return. You could put it on your personal return, except what they didn't tell you is you're kind of going to get screwed. Now, can you believe our government would do that? So if you file as a sole proprietor, and if you end up having whatever the profit is, now you have to kind of bear with me here, whatever that profit is on that business gets added in with all the rest of your income, and then you get to take your itemized deductions and you take your exemptions. And by the way, there's no more exemptions next year too. I forgot to tell you that too. They did away with exemptions. And you work your way down to taxable income, and of course, that's what you end up paying tax on. So basically, you pay income tax on the profits from your sole proprietorship. But if you look further down on that page too, there's a line that says self-employment tax, which is the same as Social Security tax. You end up paying Social Security tax on that as well. So sometimes you could have enough other deductions so that you don't even owe any income tax. But the calculation of your self-employment tax is totally separate. So you end up paying Social Security tax on the profits from your business. So let me give you an example. Make believe you made $100,000 in your sole proprietorship. You paid income tax on 100, right? You also pay Social Security tax on 100. Social Security tax, I'm slurring my words. Social Security tax, say that 7 times real fast. Social Security tax is about 15%. 15% of $100,000 is $15,000. You would end up paying income tax on the 100 and Social Security tax on the 100. If you filed the same tax return, there's a few more parts to this, so it's a big picture overview. If you filed the same business return, but instead of filing it as a sole proprietor, you filed it as a subchapter S corporation, you would owe income tax on the 100, but you wouldn't owe the Social Security tax. Subchapter S corporation profits are not subject to Social Security tax. So please explain to me, this is a rhetorical question, why, if you had a choice, A, I can file it as a sole proprietor, increase my chance of audit dramatically, by the way, end up paying, in my example, end up paying $15,000 more, have no liability protection, or basically then, or form an LLC, file it as a subchapter S corporation, pretty much eliminate the chance of audit, and save $15,000. Let's take a vote. Who votes for option A, pay more? Now think. Okay, time's up. Who votes for option B? All right, good. So that's the advantage. And you would not believe how many, listen, remember I told you my clients are from all over the country? You would not believe how many tax returns that I look at that other CPAs have done. I could write volumes of books about how many returns other CPAs have screwed up, either by out-and-out errors or by errors pretty much a bad strategy. It's unbelievable. And for whatever it's worth, I was only a C student. I'm not that smart. Just remember, the C students, we hire the A students, okay? But this is Taxes 101, and I routinely see this happen all the time. So, my time is up. I just want to say one last thing. First of all, thanks for listening. Thanks for laughing at my jokes. It's important to me, you know, okay? I have not much else to live for, okay? I have like hundreds of returns sitting in my office. I could either be here making you laugh or doing tax returns, okay? The other thing that I always tell anybody that, you know, that works with the McPhees is that the truth is I'm here to help you. I charge nothing for consulting. If you want me to look at last year's tax returns, I'll look at them. I don't charge you anything. Even if you decide you want to stay with your accountant, that's fine. If you want me to look at your tax returns before you file them, even with the other accountant, I'll still do that. I mean, so, you know, not a problem. I mean, it's what I live for. What can I tell you? You know, you know, I live in Vegas and all I do is tax returns. Something's really wrong with this picture. That's all I'm telling you. Any other questions? I'll hang around for a little longer if you want. And my card is at the back, or you can get me through to McPhee's. And again, I know I have some clients out here. They haven't stormed the stage to kick my butt yet. So I presume I did okay. I mean, and by the way, we have one last thing. We have a really great office. Our staff is just out of this world really good. We have a lot of CPAs. Our office does everything from real certified audits to, I said, representation work. Here's an interesting niche we've developed. We have all the pot dealers as clients. Most CPAs, marijuana is a huge business out here in Nevada. I mean, it's bringing in tons of money. And it's still illegal. While it's legal under state law, it's illegal under federal law. The other CPAs don't want to do the work for the pot dealers. Would anybody like to take a guess on how they pay us? Oh, yeah. Now, this would not look good if we put a lot of stuff on Facebook. This would not look good. However, we've had our partner, Lisa, making it rain with $20 bills. The other day, they made it rain with $100 bills, okay? Now, the guys might understand that concept of making it rain a little better than the women. But basically, it's taking the money and flying. You know what that is. Come on. Come on. I know you've never been to one of those places. You just heard about it, I know. But yes, so yes, we do all the pot dealers, go figure. So one day, I was really depressed. I think my cat died or something. I'm a big animal lover, and I was really upset about the cat. And one of the pot dealers came in. Why? Jack looks really, really depressed. And I said, well, his cat died. And they said, hold on, we'll be right back. So they drive home, and they bring me back marijuana brownies. Have Jack eat these. He'll feel much better. Thanks for listening. I really appreciate it. Okay.